Part 1. Why Retail Buys. Late. The illusion of safety. Most retail investors believe that markets reward patience and confirmation. They are taught to wait for clarity, positive news, and strong trends before taking action. At first glance, this seems logical. After all, why buy when things look uncertain? But this belief is exactly why retail investors consistently enter markets too late. Markets do not reward confirmation. They reward early positioning. By the time price looks safe, risk has already increased. Retail investors typically enter after 3 conditions are met. Price has already moved up significantly, news coverage is positive, and social sentiment turns optimistic. This creates a powerful illusion of safety, but markets are forward-looking. Price moves first, narratives follow later. When retail investors finally feel confident, smart money has already been positioned for weeks or months. This pattern repeats across every asset class: stocks, crypto, commodities, and even real estate. In early stages of a cycle, uncertainty dominates. Headlines are mixed, volatility is high, and most investors are cautious. This is when institutions quietly accumulate. Why? Because uncertainty creates cheap liquidity. Retail investors demand certainty. Smart money understands uncertainty is where opportunity lives. The problem is psychological. Humans are wired to avoid discomfort. Buying during uncertainty feels wrong. Buying during optimism feels safe. Markets exploit this bias. As prices rise, early buyers gain confidence. Late buyers feel pressure. Nobody wants to be left behind. This is where retail begins to chase. The higher price goes, the safer it feels, even though risk is increasing. This is the paradox of markets. Comfort increases as opportunity disappears. Retail investors rarely ask an important question: who is selling to me right now? At market tops, someone is always selling. That someone is usually smart money distributing risk. Retail does not lose because they are unintelligent. They lose because they are trained to react instead of anticipate. Financial education often focuses on indicators, patterns, and news, but it ignores positioning and timing. Smart money does not wait for confirmation. They wait for mispricing. When price and sentiment are disconnected, opportunity emerges. Retail buys when price confirms strength. Smart money buys when price reflects fear. Understanding this difference is the first step to breaking the cycle. Markets are not fair. They are competitive systems designed to transfer money from the impatient to the patient. If you want to stop buying the top, you must accept one uncomfortable truth: the best opportunities never feel safe when they appear. Part 2. How smart money uses liquidity and narrative. Smart money does not trade based on excitement. They trade based on liquidity. Liquidity is the ability to enter and exit positions without moving price too much. Large players cannot buy or sell instantly. They need time. And more importantly, they need counterparties. This is where retail comes in. During early accumulation phases, liquidity is thin. Few participants want to buy. Prices move slowly. Narratives are unclear. This environment allows smart money to build positions quietly. But when it's time to exit, they need buyers. That's when narratives become bullish. Media headlines shift. Influencers grow confident. New era stories emerge. This is not accidental. Narratives do not drive markets. They justify them. When price has already risen significantly, narratives align to make the move feel logical. Retail interprets this alignment as confirmation. Smart money interprets it as an exit opportunity. Every major market top shares this structure. Strong trend, positive news, high confidence, high participation. This is maximum liquidity for distribution. Retail often believes institutions manipulate markets in a dramatic way. The truth is simpler. Smart money understands human behavior. They don't force retail to buy. They allow retail to buy when emotions are strongest. Fear of missing out is the most powerful liquidity source. When everyone believes the upside is guaranteed, selling becomes easy. This is why smart money exits early, not because they know the exact top, but because risk-reward has flipped. At some point, upside becomes limited while downside expands. Retail ignores this shift because narratives are still positive. Institutions reduce exposure while price still looks strong. By the time the trend breaks, distribution is already complete. Retail then asks, what went wrong? Nothing went wrong. The cycle completed, liquidity dried up, and price adjusted accordingly. Understanding this dynamic removes the mystery from market crashes. They are not random, they are structural. Markets move from accumulation to expansion to distribution and finally to contraction. Retail participates mostly in the expansion and distribution phases. Smart money participates in accumulation and exits during distribution. Once you see this pattern, you cannot unsee it. The goal is not to fight smart money. The goal is to stop acting like exit liquidity. Part 3. How to think like smart money without being one. You do not need institutional capital to think like smart money. You need structure, patience, and emotional control. The biggest mistake retail investors make is believing they must always be active. Smart money is selective. They wait more than they act. The first principle is understanding cycles. Markets do not move in straight lines. They expand and contract. Buying late in an expansion is dangerous. Buying early in a new cycle is uncomfortable, but profitable. Instead of asking, is price going up? Ask, where are we in the cycle? The second principle is sentiment awareness. When everyone agrees, risk is high. When opinions are divided, opportunity exists. Extreme optimism is not a buy signal. Extreme pessimism is not a sell signal. Retail tends to invert this logic. The third principle is liquidity awareness. Price moves easily when liquidity is low. It stalls when liquidity is saturated. Sharp moves often happen when few expect them. Slow moves happen when participation is high. This is why breakouts fail at market tops. The fourth principle is risk management. Smart money does not aim for perfect entries. They aim for asymmetric risk. Small downside, large upside. Retail often accepts large downside for small upside, without realizing it. Finally, discipline matters more than intelligence. Most people know what they should do. Very few can do it consistently. The market does not reward knowledge, it rewards behavior. You don't need to catch the top. You don't need to catch the bottom. You only need to avoid buying when comfort is highest. If you can do that, you are already ahead of most participants. Retail loses because they chase certainty. Smart money wins because they tolerate uncertainty. That is the real edge. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from Macrocycle Lab. See you in the next video.